Well, hello and a very warm welcome to this Scope Ratings webinar. Where are we headed on European bank asset quality? My name is Keith Mullin and it's my pleasure to be your moderator for today's session. Now, the theme of bank asset quality has once again moved to the fore as Europe heads towards economic slowdown amid raging inflation, rising interest rates, a weakening euro, as well as energy supply and cost of living crises. Tighter financial conditions and challenging economic prospects have materially pushed up the risk of NPL formation. So two immediate questions spring to mind. Could the long-run downtrend in European banks' NPLs shift into reverse? And how are European banks adapting to alleviate pressure on asset quality? To answer these vital questions, I'm delighted to be joined today by Nicolas Hardy, who is Deputy Head of Scope's Financial Institutions team.
Hello,
in a moment, Nicolas will take you through a presentation, and after that, we'll be very happy to take your questions. So please type them in to the questions function on the platform, and we'll do our best to answer them at the end. Now, Nicolas will be dividing his presentation into three segments. He'll first look at mid-year asset quality data and give some context on the basis of historical trajectories. He'll then go on to expound on Scope's central expectations for the rest of this year and into 2023. And then he's produced a pretty fascinating what-if scenario analysis, and he'll address the topic from the perspective of whether a doubling of the stock of bad loans is manageable for banks. So with that, let me hand over to Nicolas, and let's perhaps bring the presentation up to full screen. Nicolas, it's great to see you. The floor is yours.
Thank you very much, Keith. Yes, indeed, interesting topic those days, the evolution of asset quality in Europe. I'm delighted to share the views of Scope Ratings financial analysts team. So we have analysts all across Europe, Frankfurt, Berlin, Milan, London, and Paris, and I'll be sharing our views on that topic. So as you highlighted, Keith, what is very interesting at that stage is that we are now standing after a very long period of asset quality improvements, a long period of reduction of the stock of NPL across Europe. So the key question is at what speed could we see a reversal of that trend? So you can see on the slide, the chart A, that the stock of NPL at the largest European institutions peaked around 2015, 2014, after the great financial crisis. And since then, we have had a continuous reduction of this stock. That was true both for retail exposure and for corporate exposure, trending down on both sides. So it's interesting to see that it peaked quite a few years after the end of the great financial crisis. This is an interesting topic for us today also. And what is also quite interesting is that despite the pandemic, despite the dip in terms of GDP growth, this was still a straight line during that period. So of course, we know the reason. Massive support measures have helped the borrowers who would have probably faced some difficulties at that time. And we have had a strong rebound in 2021 also. It explains why we are now at about a third of the level where we were at the peak. So close to 1 trillion of bad loans at that time, around 2015, and now below 400 billion, about 370. Of course, most of the NPL reduction was concentrated in a few countries. And in chart B, you can see all the efforts that were implemented in recent times. For instance, in Italy, Italian banks were very active in recent times. Since 2019, offloading bad loans, but also working on their stock of NPLs and benefiting from improving operating conditions, a strong 2021 year, and this was also very positive for banks' performance. So that's really the long-term trend up to year-end 2021, and we have also some very interesting top-down data from DCB, the EBA, up to the end of the first quarter 22. We'll have quarterly updates in the coming weeks, and in the meantime, we've had also the interim results from the bank, most recent data, and they do confirm still that the trend has somewhat continued until so far. I would say so far so good. We continue to see very resilient asset quality indicators. So if you remember this loan classification according to IFRS 9, when we look at customer loans, banks classify banks according to basically three categories. Stage 1 and Stage 2 are performing. Stage 2 could be seen as the equivalent of watch list, and Stage 3 refer to non-performing loans. So chart A, what have we seen since the end of 2021? A continuing improvement of NPL ratios across the board for the largest banks. You can see that on chart A. And some issues, very specific issues at some banks, either because they were exposed to headlines like the war in Ukraine, and because they have operations in Ukraine and in Russia, or indirectly were exposed to development in relations to the war, so they had to book some provision. And for the UK banks also, what we can see, the spike in Stage 3 loans was more related to a new definition of default, the implementation of new methodological changes, and it was not really related to a degradation of the underlying quality of the book. So quite comforting data so far in terms of Stage 3 classification. There is no reversal for the first year of the year. Of course, it's very interesting then to move to how banks are managing sort of watch list exposure, so the Stage 2 loans. It's not clear-cut to interpret the evolution of Stage 2 loans, because they could point to a degradation of the quality of the loan, a deterioration of the quality of the loan books, or they could also suggest that banks are more conservative and want to place in this category loans that are still performing okay, but needs really to be monitored. And this is also something we have seen during the pandemic. And so far, those exposures have in general performed relatively well. And we have seen banks reclassifying in Stage 1 loans that used to be Stage 2 classified as Stage 2 in 2021. So nothing to worry there again, but this is an area of attention, of course, and at what speed banks are actively managing this particular exposure. Finally, regarding the Pnl impact, so the amount that banks are allocating based on their quarterly first half result to cover potential credit risk issues. When we look at the cost of risk, in general, we can see that compared to a 3-year average, 2019, 2021, and this is interesting as an average because we've had difficult times in 2020 and banks booking a lot of provision, even precautionary one, and mainly precautionary one in 2020. But for 2019 and 2021, those were rather good years for banks. So the average is a good reflection of a sort of through the cycle measure. So comparing the annualized cost of risk, so impairment charges for the first half of the year, we can see that in general, it's below the red line, which is 100%, would mean that a bank has allocated during the first half an amount equivalent to what it booked on average during the last 3 years. And there we can see that apart from very specific cases, again, most of them are related to issues in relation to Ukraine or Russia, or sometimes like Commerzbank, banks provisioning for some specific issues that may not repeat in the future. So it needs to really to be interpreted in more details. There is no general trend indicating that at the moment banks need to allocate more provision because stage 3 are increasing, or they really feel the need to be even more conservative at the moment. We'll come back to that. So a long period of asset quality improvement across Europe. At the same time, it's also, of course, very important to keep in mind that the situation, of course, varies a lot across countries. Chart A highlights the fact that we have seen a convergence in terms of NPL ratios, but how banks across Europe are handling asset quality figures still varies a lot. And there is a good example here with the approach in terms of coverage level. We can see a wide discrepancy across the board, across European countries. And of course, it needs to be seen in context also. In some countries, most of lendings are performed against collateral. So in case of defaulting loans, the requirement in terms of additional provision may be lower than in other countries. So this is not uniform across the board. It needs to be qualified also in terms of underlying nature of loan books. And the same applies also to how banks across Europe are approaching stage 2 provision. There are many different labels also under the provisions that are used for performing loans. Some would refer to precautionary, ex-ante provision, forward-looking provision, and also we have seen banks communicating on management overlays, so efforts to add to what would be directly prescribed by accounting measurements. So it's interesting also to see how banks are navigating. Again, how banks are managing stage 2 provisions could be interpreted both ways, pointing to an increasing of watch lists, sectors that are showing signs of deteriorating asset quality, not yet non-performing, or a sort of conservative stance. So really qualification matter on that part. Another interesting topic when we look at the current situation is really how the sector that were the most exposed during the pandemic to a potential asset quality deterioration, how they have performed. And also what is interesting during the pandemic to follow in terms of asset quality development, of course, was the implementation of large state-guaranteed loans in some countries, and how we are going to transition and exit those support measures. It applies also, of course, for the moratorium. And for all those three issues, how they could unfold as we enter a new phase. And so far, of course, the more we wait, the more we can see that the remaining parts that did not come back to pre-crisis level, so banks who did not reimburse public guarantee schemes or counterparties that are still benefiting from moratorium, we can expect that those exposure may be somewhat more problematic in the future. Otherwise, they would have come back to the pre-pandemic situation. And regarding the sector exposure, we came to the conclusion, looking at the most vulnerable sectors, that it's either widespread across sector. So in the case of manufacturing, in the case of real estate activities, we haven't seen a correction so far. And for the sector that were usually identified as being directly the most exposed to the pandemic, the lockdown measure, the exposure tend to be relatively small. Those sectors were benefited a lot from support measures, so it did not materialize into really generally deteriorating asset quality and indicators for the banks. So I would say, so far so good. The trend has continued even during the pandemic, and this is a solid starting point for banks.
Excellent. Thank you very much, Nicolas. So, look, you've painted a pretty positive picture of the trajectory of NPLs in the last few years, and of course, banks survived the pandemic largely thanks to extraordinary fiscal and monetary support. So, as we stand today, as I mentioned at the beginning, as is very clear to everyone, we're facing a number of, I guess, new risks. So on the basis that past performance is no guide to the future, could you then perhaps go on and to talk about the situation today and how it might unfold, let's say, for the rest of this year, there's not much left, and 2023?
Yeah, absolutely. Are we at a turning point, and how could that unfold? I think this is the critical question. Indeed, we had the same question in March 2022 when we entered into the pandemic. And again, it's interesting to see where we are after those 2 years. At the moment, so our central expectation for the next 18 months would be a gradual and moderate increase of NPLs. So this is really a central expectation. And so what are for us the key considerations explaining this mild evolution of asset quality indicators? I would first point to the current central macroeconomic scenario for Europe. At the moment, it continues to be a soft landing. So we all know that it remains exposed to downside risk. OECD and others are really very clearly showing how month after month macroeconomic assumptions and forecasts are being revised down dramatically since year-end 2021. And at Scope, we also flag this very important issue. We can see the evolution of the baseline scenario for the largest European economies, how they have moved since end 2021, with the difference since December. So for instance, for France, it's 1.6% lower, a percentage point lower than it used to be at end 2021 regarding expected real GDP growth for 2022. But still, when we look at this overall level for 2022 and even 2023, this is for most of the countries we are looking at here, it's in line with the medium run potential. It's also very close to the level where we were pre-pandemic. So really, how could asset quality evolve over time? I think this is a key input for anyone looking at the future, a long period of improving asset quality figures, and at the moment, still a soft landing as a central assumption. So this is why at the moment, our efforts are more geared toward the identification of pockets of risk, like the most energy-intensive sectors, clients that would be vulnerable to a more rapid increase of interest rates, for instance, in countries where we have variable rates and inflation going up rapidly. So really, it's more a pockets of risk identification approach than being worried about the entire economy at the moment based on this central expectation. And something also very important to factor is also the possibility, and that was a key learnings from the pandemic, that we could see targeted support measure for the most vulnerable sector. It's not to say that we expect something similar to what was possible, affordable at the beginning of the pandemic, but that should, at least for 2022, play a role in the softening of the soft landing for a part of the population. And just a conclusion for this slide on the macroeconomic environment, we are all conscious that things can evolve very rapidly. There are many downside risks in terms of energy supply, and my colleagues from covering sovereign ratings have published end of August a piece on a few countries, including Germany, where we can see also the possibility of alternative, more severe scenario and what the impact could be on those various economies. For banks, what is positive is that for many countries, reserves were replenished for this winter. So it's very difficult to imagine that we will see a surge of asset quality problem in the short term, thanks to all the efforts to sort of accommodate, neutralize the energy supply issues. So this is more for 2023. So that was on the macroeconomic front. And then what does that mean for banks? Very importantly, if we stick to the central assumption of a soft landing, it means also that banks will continue to post reasonably supportive performance for the rest of the year. And that was a challenge for European banks when they announced their interim results, really to explain how they've performed so well, where the sentiment was shifting. And this is based on the time lag effect between what we've experienced, the world in which we live those days, and what we anticipate. So far, so good for banks. And what is interesting also is that rising interest rates, specifically for banks, structurally in Europe, should be a plus, a net benefit for the banks. It may take time to unfold, but balance sheets structurally should benefit from the rise of interest rates. And that means for banks a capacity to absorb eventually higher loan losses. So this is also a very important development. I won't expand on the de-risking during the past decade following the last crisis, what banks did in terms of de-risking of their balance sheet, how their business model, the nature of the balance sheet has changed. Also, the number of regulations that were put in place to push banks to build up additional loss absorption capacity in terms of core capital, and also works in terms of provisioning buffer. And I'm not talking here even about all the efforts to facilitate banks' resolution in case of even more difficult issues. So what are the other final considerations that may be looked at? First, maybe NPL formation will take time, may take time to materialize. So the timeline we've seen after the last financial crisis, the fact that it peaked only around 2015, could again provide some time for banks to accommodate a more difficult operating environment. It will take time until things get sour, and at the moment, again, the starting point is comforting. And what is also interesting to monitor is the potential continuation of efforts to help banks to offload bad loans. So this is critical for banks to improve their balance sheet. It explains part of the NPL stock reduction in recent years. Of course, the key question in that case is, if banks are offloading bad loans, are they still around in the economy, and who is taking care of them? We don't want to see a ripple effect where banks invest in, for instance, securitized loans and are still exposed to this apparent improvement of balance sheet. So this is to be really cautiously monitored, but it's part of the initiative that are supposed to help banks cleaning their balance sheet in good and bad times. And it proved efficient in recent times. Those are material amounts. It was visible in some countries like Italy, like Greece, like Ireland, and it should continue as long as operating conditions and terms and conditions under which those bad loans are offloaded from banks' balance sheet also are attractive for the caretakers, I would say.
Okay, thanks. So Nicolas, interesting. So look, your central core thesis, as you mentioned, is for a soft landing. But that soft landing could potentially be looking quite precarious depending on the turn of events. And yet you said yourself, things can evolve very, very quickly. And you've pointed to a number of potential downside risks. And it's kind of pretty hard to pin those down in terms of modeling the outcomes and factoring them into potential future NPL formation. But I mentioned at the beginning, you have done this pretty interesting what-if scenario, which basically says, okay, well, what if my central thesis doesn't actually pan out? What then? So can you talk about that?
Yeah, sure. So we all want to know where we will be in the coming years. So there are many ways to look at that. Of course, this is really it's fraught with uncertainty, and it's a difficult exercise because there are so many variables there. What's maybe interesting is to have, we really like this approach of having what if scenario. So this is not a forecast. This is not the central scenario we expect for European banks in the coming 18 months, to be very clear. It's just an analytical tool to see how banks could cope with different evolution of asset quality figures and NPL stock. Let's start with this one. What about a doubling of the stock of NPL? So we are currently at about 2%. What does it take to double this amount? And it's not really if that represents a 4% NPL ratio, because we can imagine also that probably lending dynamics, so the denominator of the NPL ratio, could change over time, so that could be higher. What is really important is to look at the stock, what it means for banks' balance sheet. So a doubling would mean that from the current roughly 360 billion for the significant institution across Europe, and if I recall well, for the sector at large, we are above 400 billion, but there is not a very big difference. So just to keep in mind the big picture approach there, what would that mean to double this amount? So getting closer to 700 billion within an 18 months time frame. And that would bring us back to the 2017 level. So, and we have seen all the efforts afterwards. It was quite a hard number. We were halfway compared to the peak level. So what does that represent for banks? In aggregate, a peak of, again, an addition of 350 billion NPL. When we look at the bank's first line of defense, so pre-provision profit, we can see what we've done the math for a sample of about 50 large European banks, and we can see that a total pre-impairment profit is broadly equivalent to what it would represent to cover 50% of that increase yearly, on a yearly basis, and based on recent performance. So we could discount the recent performance, and this is not going to happen in a year, probably. But really, the conclusion is that banks have the capacity to cover 50% in terms of provisioning requirement. And 50%, why do we take this? Because it's what we have across Europe at the moment for bad loans. You know, when bad loans, where loans are collateralized, defaulted loans do not require 100% coverage. So in aggregate, we believe that banks have the capacity to cope with such an evolution of asset quality deterioration over this short period of time. And by saying that, we are not taking into account the fact that banks have made effort also to build up stage 2 provisions in recent years, and they are still managing actively stage 2 provisions, sort of precautionary provision, moving them from COVID-related issues to emerging risks. That was a key message for some banks during the Q2 result seasons. And on top of that, thanks to all the efforts to build capital, core capital, there is still a part of excess capital on top of regulatory requirement that could provide additional buffer. So this is not to say that it will be easy for banks to accommodate such a reversal of the trend, but a doubling of the current stock of bad loan would be manageable for banks. This is what we can see at the moment. How could that unfold? How realistic would it be, a doubling? Again, this is just a what-if analysis. It's interesting to look at how the stock has changed, the pattern, the composition of the stock of NPL has evolved, for instance, the last 5 years. We can see, for instance, and we have a set of very interesting data on the stock of NPLs on how it's changing quarter after quarter, looking at the ECB supervisory banking statistics. Chart A illustrates who were the most active in terms of reduction of NPLs. So it's by the size, total assets of the banks. And we can see that the small banks have reduced the portion of banks that have between 30 billion and 100 billion total assets. This is where we have seen a very large improvement. The same for the 100 billion, 200 billion bucket. In case of a reversal and more difficult operating condition, this is likely where we should also focus our attention, because this is where potentially we would see a reversal of the trend. It's more difficult for concentrated business models when they are exposed to specific pockets of risk to cope with those developments. So this is where we should look in more details. Interestingly, this is probably, if we are to see a reversal of the trend, where also we could see some consolidation across European banks, because those banks would potentially suffer more than the others. Another interesting breakdown of NPLs is by geography. And there, what's really interesting, I think, is the fact that out of the total stock, we can see SSM, the single supervisory mechanism, means that here we are dealing with the part of the banking sector that is directly regulated by ECB. And I think it's a comforting factor to see how that has evolved over time. And the convergence in terms of regulatory expectation and requirement there is a comforting element. This is where the stock has been actively managed. And also what is interesting is the size of the rest of the world in the total stock. So we need to keep in mind, looking at how this evolution, how the stock could change, to keep in mind that a large part of it also is related to credit exposure outside of Europe, emerging markets and others. So it's not only about the soft landing in Europe, it's also about the performance of the rest of the world where the banks are operating. And finally, the breakdown of NPLs by country also. To what extent we would simply see a reversal of the trend? Are we going to go back to the situation where we were in terms of distribution to the total stock? What has changed during the last 5 years in terms of structural improvement? I think one country where we have seen a fundamental change, for instance, is Ireland. So it would be too simple just to go back to where we were before. But probably relativities still matter on that front. So the what if scenario, is it realistic? We could, of course, have a long list of more negative, more severe scenarios. There are obvious candidates, issues on that list. I could only point to 3 main issues that are making headlines those days. More severe geopolitical issues like military tensions, an escalation of military tensions. In Europe also, the functioning of the EU, how support measures are going to work, the risk of potential polarization and fragmentation in the EU is a very important issue also. But here we are more on the macro/political side. Energy-related issues, we've looked at that also with Germany and other countries. What are the countries that cannot accommodate easily a change of energy sources, the substitution effect, how difficult it could be for some countries and companies or households, and how we are going to manage the transition. Again, I don't think it's maybe a very important issue making headlines currently, but thanks to the replenishment of the reserves, it's maybe not for this winter, but a daring issue for 2023. And finally, very relevant for banks, the side effects of rising interest rates. How is it going to impact affordability in terms of lending for some borrowers, rising cost of risk for those cohorts of borrowers, and what is ultimately also the impact on lending volumes? So a sort of trade-off between rising interest rate, potentially rising interest revenues, but an expected potentially slowdown of loan production over time. I'll stop there, and you have at the end a list of recent research pieces that we've published, sovereign colleagues, ourselves, the financial institutions team. We publish regularly on European banks, including on asset quality, and also we have a bank capital quarterly, which is quite known in the market. Thank you. I stop.
Great. Yeah, good. Thank you very much for those comments, Nicolas. Very insightful, as always. So we've got some time now for some questions. So please type your questions into the questions box, and we'll see if we can answer them. So Nicolas, I've got some questions here for you, and they kind of obviously relate to things you said during your presentation. I guess the first one really is what just follow on from your most recent comments, your about interest rates. So you mentioned interest rates there are side effects of rising interest rates for banks. Now, clearly everyone says, oh, it's great for banks because their net interest margins go up automatically. But there's a lot of collateral risk in rising interest rates. So what's your kind of gut feel about how the interest rates scenario plays out for banks in the next 18 months?
So as I said, I think there is a consensus that structurally banks have positioned their balance sheet to benefit from the interest rate hikes. And this is the general, I think, expectation in the medium term. It's very complex, of course, to model how it's going to unfold. We believe that it's more the soft landing of the economy that will continue to support banks' performance toward the end of this year. So resilient performance until the end of this year, thanks to probably lending dynamics, because many clients are willing to lock the most favorable rates, expecting that rates will continue to go up. So maybe it's more on the lending volume that banks will continue whenever they can afford lending to their clients, knowing that rates are going to increase. That would be the main benefit for banks in the short term. In some countries, and the liability side may, in the short term, reprice more rapidly than on the asset side for some reason, like regulated savings, caps on lendings, and this is issues that we face, for instance, in France with the cap on what we call taux d'usure, usury rates, and also countries where we have regulated savings, like in France, also in Belgium. Those are important elements when we try to look at the speed at which rising interest rates could benefit banks. So it's not really a clear cut, but it should be a structural benefit for banks in the long run.
Yeah, thanks. There is a question that come in which is related to this. Now, as we've all seen, the cost for banks of raising wholesale liabilities, I mean, there's been a dramatic change in the last 6 months in the cost of funding. Do you see any significant impact for bank profitability arising out of that dramatic repricing?
Yeah, so I would like to see this issue in the context of where are we heading to in terms of asset quality. So the thing here, of course, banks are not all European banks across the board are not all exposed to the same issue in terms of rising cost of wholesale liabilities, wholesale funding. Many banks have been very active during the first part of the year and have completed a large part of their funding plan for this year. So this is also a comforting factor. Yeah, it's more difficult those days for banks, and the market was not always very open for banks in terms of wholesale funding. The issue, of course, it's in terms of Pnl and what's left in terms of pre-impairment profit for banks to accommodate rising cost of risk. So this is where I would see the issue. But at the moment, we need to go probably country by country, where sometimes there is a higher correlation between the evolution of sovereign, the way cost on sovereign debt is evolving, and how cost of funding for banks in those countries also is evolving. What really matters also for us is the functioning of Europe in that country, in that context. So, and how liquidity is managed across Europe, how the ECB is going to manage going forward the liquidity in the market, and maybe it matters also a lot in terms of rising cost of wholesale liabilities in the future.
Yeah. Okay, thanks. There's another question that's come in, again, very topical. It's like one of those sort of elephant in the room questions, which is this: what will banks do with the collateral at the end of TLTRO in their balance sheet?
Yeah. So is it related to asset quality? I'm not sure. We are all interested about the future of TLTRO. We have seen encumbrance ratios moving up because TLTRO require collateral. I'm not going to dig into that in too much detail. What I can say about TLTRO is really that many banks have managed TLTRO. The excess that was provided to banks to neutralize liquidity risk during the pandemic is still there. Most of the banks have managed this liquidity very proactively and conservatively on both sides of their balance sheet, parking this resource into liquid assets. We've seen that potentially there is an interest for cover bonds as replacing sources for TLTRO funding. Again, banks are not relying on TLTRO to fund their core business, and they could continue to get liquidity in the market thanks to secured debt issuances. we don't see TLTRO as being a big issue for banks. It was more an opportunistic move, deliberate move also to neutralize liquidity risk and facilitate bank lending during the pandemic. So it's probably something to monitor for the rest of the week, as the ECB probably has to say something on that, in line with what was the comments made earlier this summer.
Yeah, indeed. Now, you mentioned initiatives from the regulators to create this market infrastructure to help banks get loans off their balance sheet. Do you want to talk back a little bit more about that? And I mean, this has been going on for the discussion has been going on for some years. How do you see that?
Yeah. So the ambition in Europe is to develop securitization. That's a clear ambition of the European authorities to create an ecosystem whereby banks can offload, actively manage bad loans. So the ambition is to have the creation of a safe NPL secondary market. And so there are initiatives going on, like, for instance, the introduction of a template to report NPLs on banks' balance sheet and facilitate the standardization of NPLs transaction. It's not that easy to follow the speed at which transactions are being performed. Most of them are still private transactions, and it's really an ambition and relatively marginal still at this time. So we are not really factoring a lot the development of such a compartment, such an active NPL secondary market to explain or expect that NPL will remain at low level on banks' balance sheet. But this is there are ongoing initiatives to facilitate that. And of course, it will continue even under more difficult operating conditions, depending on the willingness and the ability of banks also to continue to sell NPLs at acceptable rates for the potential buyers. So this is we should see that also in that context.
Yeah. Okay, Nicolas, there was a question about house price exposure, and I'm just wondering whether perhaps we just park that one for the time being, and perhaps we can circle back to our questioner, because it's quite a specific question. But I mean, take a look, if you want to have a stab, then feel free. But
sure.
Yeah.
Yeah. So the evolution of property prices and how that could impact the quality of mortgage books. Yeah, of course, it's a critical question. Interestingly, I would say this issue around property price movement and some overheating flagged in some countries, that was also a pre-pandemic concern. It has remained, and with the low for long interest rate, it's still there. Now, I think there are where we should focus our attention is probably in countries where we have variable rates, because this is where potentially the affordability issue would be more critical than in other markets. So variable rates in some countries, no need to name them, they are well known. That's where we should focus our attention. And property price correction does not always mean increasing bad loans on banks' balance sheets. It really depends if it relates to speculative assets or not, commercial real estate, speculative residential assets. And thanks to the de-risking over the past 10 years, I think it's unlikely to see simply a repeat of what we've experienced in the past, like in Spain, for instance. And it's always interesting, I think, to keep in mind what happened, for instance, in the Netherlands during the last price correction there. It was a 20% price correction, and the level of defaulting mortgages remained very low. And that was because despite the large number of borrowers in negative equity, you just keep on reimbursing your mortgage. You don't move, so a slowdown of the property market, but this is not leading to a deterioration of asset quality indicators on banks' balance sheets. So really, it's country by country, and I think we need to focus on countries where variable rates maybe will have most of an impact.
Yeah. Okay, yeah, makes absolute sense. There's a question about your what-if scenario. Now, you were very clear in laying out your central expectations, and you're equally clear that your what-if wasn't a forecast. That said, I guess it's a bit of a blue sky question, but in your mind, what's the likelihood of your what-if scenario actually unfolding?
Yeah. So what we've presented today is a solid starting point for banks, and we can see that quarter after quarter we are still there. So maybe now we are at a turning point. Maybe indeed energy prices, rising interest rates are going to lead to increasing NPLs on banks' balance sheet. Again, there is this time lag effect. For this winter, I said that also I think we are on the safe side in terms of ability to continue to have access to energy sources. It's very difficult to see this scenario for the remaining half of the year unfolding very rapidly. So that would lead to a very rapid acceleration of the problems if we were to stick to a doubling by end 2023. It's unlikely to happen following this linear trend in 2022, and the third quarter is already behind us nearly. So it will be more the fourth quarter that may be an issue for banks, I believe, unless they want to be really conservative and increase precautionary provision. So it's very hard to see this at the moment. It's very hard to imagine that this doubling over an 18-month period starting now is a realistic assumption. It could get so and accelerate in 2023. What I can say is that at the moment, for the rest of this year, 2022, it looks under control for banks.
Okay, very good. That potentially is a good end point for our discussion today, because there are no more questions that are coming from the audience. And so I think unless you have anything more to add, Nicolas, I think we should close here. And so thank you for tuning in and watching. I hope you found it useful and insightful. As a small favor to us, before you go, we just do have a small survey question that we'd love you to fill in. It'll take 30 seconds to do. So if you just click on the give feedback and answer that will be immensely helpful. It just helps in our planning around outreach to market participants. So while you're doing that, I just wanted also to draw your attention to the fact that in the next few days, we will be publishing the next quarterly asset quality report. This is a quarterly report that Nicolas, Marco Toriano, and the rest of the banks team put together, covering, I guess, a lot of the things that Nicolas talked about today, which has an overview at the front and then some more specific regional breakdowns. And so look out for that. It will be on the Scope Ratings website. I won't give an exact time, but I'll just say in the next few days. So look out for that. And do please check out also, as Nicolas mentioned, the Capital Quarterly, which focuses on perhaps more capital related, not just AT1, but overall bank capital, with some quite useful data on things like capital buffers, etc. So on that, I'd like to thank everyone again. Thanks, Nicolas, for your comments. We will be back for more of these sessions in the future, but for now, it's goodbye from us.
Goodbye. Thank you very much for the questions.